Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
Moving on to the continuing vibe check of the economy, it's time to return to some of those charts of consumer sentiment that we've been speaking about before. An interesting chart here showing the divergence between the present situation index and the expectations index. This comes again from the Michigan Consumer the Conference Board. And looking at I think it's interesting, first of all, to look at the present situation index. This is the dark line on the chart, and it did dip precipitously during COVID, well below the norm, well below even a mean. And then it spiked again in around about 2021 and returned to a fairly high level relative to its history in the years since COVID. That has been fairly steadily coming down over the course of 2025. When we look at the expectations index, they have been really hovering around the mean, nothing out of the ordinary there. So there has been a gap between the present situation and expectations for some time, really since COVID, in that the present situation has been a lot higher than expectations. Consumer expectations have never really been that extended. And that's interesting to see that now they remain lower than average, but not that low, whereas the present situation of consumer sentiment is ticking down. So that, I think, is an interesting data point. If we compare that to small business sentiment, that seems to be moderating a little. We know that the unemployment rate has remained low, and that probably is both affecting the demand for the small business goods, as well as also being a factor that because small businesses are doing well, unemployment is remaining low. So that's a positive indicator and certainly bodes well for the rest of the economy for the rest of the year. And then when it comes to the consensus, we can see that the consensus around US growth in the light blue bar on the bottom left chart is still quite low at 2.4%, when the Bank of America Global Research consensus is higher than that. That's at around 2.8%. So there has never been over exuberance in the consensus, and that's an interesting data point. Getting back to the expectations, it's very, I think, salutary to see that despite this red hot, raging hot economy we've spoken about, expectations have seemed quite anchored. So perhaps the consumer has not, in fact, been carried away. Maybe it is the press, maybe it is the commentators, maybe it is the strategists and the economists that have got carried away. Maybe the consumer has actually kept a fairly level head throughout all of this, and that would be very interesting if that was the case. In terms of unemployment, though, that's still on the mind of consumers, and there is a sense that Americans are braced for a higher level of unemployment going forward, whereas the unemployment rate itself has stayed fairly stable, and as I said, closer to 4%, 5%, nothing out of the ordinary. The expectation around unemployment is quite a bit higher. It's even higher than it has been at pandemic extremes. So the last time it was this high was before 2010. So a very interesting general, I say, negative expectation there when it comes to employment. Perhaps that's putting one's thinking forward into where AI is likely to leave things.